Hey guys, it's Cory here. So I want to sit and have a conversation. I know there's been a lot of volatility going on this last couple of weeks. And we've been getting a couple of calls calling in saying, hey Cory, should we be concerned about these tariffs with the pending new election in place and what's going on in the world? Is there some concern about our retirement plan and should we be worried? Listen, we're always going to be worried when it comes to the markets, right? Markets are designed to fluctuate up or down just based on what's going on in the world. Anything that's uncertain is going to cause the markets to react. And that's what we're seeing right now. But in regards to whether or not we should be making moves, should we be changing your portfolio, reducing your positions, things of that nature, I want to give you guys a little bit of understanding of what I look at before I start to make decisions about pulling money out, repositioning assets, or more importantly, selling positions and going to cash, all right? So let's talk about what you guys have already in place. If you remember when you first came on board our firm, we talked about differences between apples and oranges, right? I said to you that most investment advisors, right, their focus is around stocks, bonds, mutual funds, ETFs, things that are going to move up or down in the stock markets, right? Their focus is centered around investing in investment products that are going to be tied to the investment market. And they will buy and sell, like I said, stocks, bonds, mutual funds, ETFs, things of that nature. They're typically going to buy some sort of model that's been fabricated and put together. Maybe it's conservative, maybe it's a moderate, maybe it's aggressive, whatever it might be, it's just diversified based off of what those allocations are. So this is kind of what the traditional world of investing is. All their assets, for all intents and purposes, if they had a 401k plan, and that 401k plan had $1 million in it, then theoretically, if I was looking at it from an analogy of how much risk would I have in my current portfolio, then theoretically, 100% of my money is at risk because 100% of my money is investing in the market. If you remember when we talk about, we don't care about how the degree of risk is. We care about, can I lose money? Period. That's all I worry about. If I can lose $1, it's at risk. That's all I care about. Not the degree of risk, but it's at risk. Now, if I decided that I had $1 million invested in the 401k plan or 100% of my money invested in an IRA account, then that means 100% of my money is at risk because I can move up or down within inside of this plan and I can lose money. That's all I'm asking, as how much is at risk. Well, this is a traditional way of investment advisors managing their assets. You have assets under management, they charge a fee to manage the plans. Now, if you guys remember when you first came into our office, the whole reason why you came here is because we shared our concept called the Sound Fiscal House. Let me start with that. The Sound Fiscal House is really designed for a few things. One, we created what's called the roof. And if you remember the roof, it's all about risk. Any money that we have in our current plan, all the risk is going to be inside the roof, right? So again, this is going to be your mutual funds. This is going to be your stocks. This is going to be your bonds. This is going to be your ETFs. Anything that can fluctuate up or down in value. But this is where we're keeping that portion of your assets. Now, we also created what's called the walls of the house, right? The walls, again, was money that we earmarked for income. This is where we put money at to generate cash flow on a monthly basis, annual basis, semi-annual basis, to make sure we have not all of our eggs in one basket, but we have a portion of our house to generate that return. The third part, of course, is the foundation, guys. You guys remember, the foundation is designed for one thing and one thing only, and that's safety, right? So if we put money into the safety of the foundation, it's so we can find accounts that we put money into that we can't lose any of the principal. It stays intact, all right? And then the last thing is we build out a fence around our house, right, to protect ourselves. And in this part of the protection, we focus our attention on taxes and protection, right? Okay, so this is what the Sound Fiscal House looks like. Last but not least, the chimney of the house, and it's all around emergency assets or cash, right, in case of emergency. Why am I telling you about this strategy of the sound fiscal house? Because right now is the perfect time of why we allocated your portfolio the way we did when it came to our sound fiscal house. The markets right now have been volatile, up, down, all over the place, right? And because of this reason, this is what's affecting our roof area. Now, remember this, when we started the plan, maybe if you had $1 million in the market, we don't have $1 million invested in the market. Instead, we have some percentage of this number. Let's assume, for all intents and purposes, we have 40% of your money in the market of that million. That means there's $400,000 invested in the market. But here's the thing, the other 60% is made up of the income, the safety, and the protection of principal or tax strategy called the fence, right? And if that's the case, then here's why we did that. Because we knew this was our fluctuation account. This was the money that we knew that if the market got weird for whatever reason, this is the maximum amount of money that we'll ever see some kind of fluctuation. But the reason why we created the portfolio this way is so that way, if we had to deal with these ups and downs in the market, we still are protected by the income coming in from our walls. We still have the safety and growth that comes out of our foundation, and we still are tax efficient and have protection for our long-term care, life insurance, the 𝗫𝗏s of the plans, anything along that line that covers this that are not correlated to the market. This is why we did this, guys. Listen, even though you may be seeing fluctuations in your account right now, we don't have to run to safe haven because we still have the bulk of our money still protected in our sound fiscal house approach, in the walls, the foundation, and the fence. That's what I want you to remember. Now, with that being said, if you're still concerned because that 40% is more weighting than you worried about, and you're still nervous as heck about what's going on in the market, I want you to kind of keep this also in mind. Whenever you have a stock on paper, let's say for all intents and purposes, you actually had $100,000 in the account. And let's say for all intents and purposes, the $100,000 was down 20%, okay? As long as we haven't sold the position, this is just paper losses, okay? Meaning that the stock market could rebound at some point in time because we have not permanently lost that money. But as soon as I sell those stocks, let's say if it was Apple, and I sell out because I'm in a 20% loss, as soon as I sell that, now I made it a realized loss, right? Now I have a realized loss, and unfortunately, now I cannot get that back because ultimately I made a permanent capital loss. And by doing so, now I actually do have that loss in my portfolio. I don't have the ability for it to go back up. And the reason why I said before, remember, this is only representing a percentage of your portfolio. We can weather the storms, guys. Your job is to hire me to sit here and make sure at the end of the day, we don't make rational decisions or irrational decisions. Our focus is about weathering the storm, using the plan to make sure our plan works. Make sure we have enough cash flow and income coming in. Remember, those bottom accounts that we set up, the foundation, the walls, the fence, those are designed to give you the cash flow you need while you're in retirement. So that way we can leverage the growth side of the roof over time. We don't have to react because the market is going down, that we have to stop everything we've done in our plan and go and say, let me start taking money out of the market. Let me sell off these positions and go to cash. That's not what we want to do. We want to be prudent in our approach and our strategy. And I believe that the sound fiscal house approach can help us do that. Now, with that being said, I'm very keen in understanding that fear is actually a reality sometimes. So if you feel that you have too much portfolio or too much of your investment still in the roof, and the portfolio, even though it may be weighted well under 40 to 50%, I will still make those changes if you need to, but understand we are getting permanent capital losses when we do that. And I hope that's not what we have to do. Let's follow the plan, stay on the approach, and see what goes around from that standpoint. Okay, guys, I wanted to do this video. Hopefully this gives you guys a little peace of mind. Feel free as always, contact the office if you have any questions, and we'd love to see if we can help you out. Otherwise, stay faithful, stay focused, no worries, we're here. Take care and be well and blessed. Bye-bye.